Most people believe investing is about intelligence, secret strategies, or predicting markets. In reality, most investors fail for a much simpler reason: behavior. The biggest obstacle is not the market itself, but the way people react to it. Fear, impatience, and emotional decisions slowly destroy results that could have grown over time. One common mistake is expecting fast results. Investing is a long-term process, but many people approach it like a short-term game. When progress feels slow, they abandon their strategy. Wealth, however, rewards patience. Those who stay consistent through time benefit the most from compounding. Another reason people fail is reacting emotionally to market movements. When prices rise, excitement pushes investors to buy impulsively. When prices fall, fear pushes them to sell quickly. This cycle often leads to buying high and selling low, the opposite of successful investing. Many investors also lack a clear plan. Without rules or structure, decisions become random. News headlines, social media opinions, and market rumors start influencing choices. A defined strategy provides stability during uncertain moments. Another mistake is focusing only on potential profit while ignoring risk. High returns may look attractive, but without risk control, one bad decision can erase years of growth. Successful investing balances opportunity with protection. Many people also underestimate the importance of diversification. Placing all money into one idea increases vulnerability. Even strong investments can fail unexpectedly. Spreading risk across multiple assets improves stability and long-term survival. A lack of patience is another common problem. Markets move in cycles. There are periods of rapid growth and periods of slow progress. Investors who leave during slow periods often miss the strongest recoveries that follow. Another reason people struggle is lifestyle inflation. As income rises, spending rises just as quickly. Without controlling expenses, there is little capital left to invest consistently. Wealth building requires intentional allocation of resources. Many beginners also believe they must predict the perfect moment to invest. In reality, timing the market consistently is extremely difficult. Waiting for perfect conditions often results in missed opportunities. The truth is that investing success rarely depends on brilliance. It depends on discipline, consistency, and emotional control. Those who manage their behavior effectively often outperform those who constantly chase complicated strategies. Another major reason people fail at investing is inconsistency. They invest for a few months, then stop when life becomes busy or when markets become uncertain. Successful investors treat investing like a routine, not an occasional activity. Consistent contributions create momentum that occasional investing cannot replicate. Many investors also focus too much on short-term performance. A single bad month or even a bad year can make them question their entire strategy. But markets naturally move through cycles. Long-term growth often includes temporary declines. Understanding this helps investors stay calm during volatility. Another mistake is following popular trends without understanding them. When a certain asset becomes widely discussed, many people rush to invest. By that time, prices may already reflect high expectations. Without proper research, trend chasing becomes speculation rather than investing. Lack of diversification continues to destroy many portfolios. Investors often become emotionally attached to one idea or company. When that investment struggles, the entire portfolio suffers. Spreading investments across different sectors and assets provides stability and reduces dependence on a single outcome. Many investors underestimate the impact of fees and costs. Small percentages charged by funds, brokers, or advisors may appear insignificant. Over decades, however, these costs compound and significantly reduce overall returns. Awareness of expenses protects long-term growth. Another challenge is information overload. Financial news, opinions, and predictions appear constantly. Trying to react to every piece of information creates confusion. Successful investors filter noise and focus on long-term principles instead of daily speculation. Emotional comparison also leads to poor decisions. Seeing others claim rapid profits can create pressure to take unnecessary risks. Investing is a personal journey with unique goals and timelines. Comparing results often leads to impulsive behavior. Many people also underestimate the importance of time. Delaying investing for years dramatically reduces the power of compounding. Starting early, even with small amounts, creates a powerful advantage that cannot easily be recovered later. Another mistake is abandoning a strategy after a single setback. Every investor experiences losses at some point. Those who learn from mistakes and continue improving their approach usually achieve better long-term outcomes. Ultimately, most investing failures come from behavior, not knowledge. People often know what they should do, but emotions interrupt discipline. Mastering patience, consistency, and long-term thinking becomes the true foundation of successful investing. Another reason people fail at investing is impatience with gradual progress. Real wealth usually grows slowly at first. Early gains often appear small and insignificant. Many investors lose motivation during this stage and stop contributing. Those who continue despite slow beginnings eventually benefit from the accelerating power of compounding. Some investors also expect investing to be exciting. They search for dramatic opportunities and rapid gains. But successful investing is often repetitive and calm. It involves steady contributions, diversified portfolios, and long-term holding. Boring discipline often produces better results than thrilling speculation. Another problem is reacting too quickly to market headlines. Economic news can sound alarming or overly optimistic. Investors who adjust their portfolios after every headline often create instability. Long-term strategies should not change based on short-term no's. Many people also underestimate risk during strong markets. When prices rise steadily, confidence grows quickly. Investors may begin taking larger risks than they normally would. When the market eventually corrects, those risks become painful lessons. Another reason people fail is lack of clear financial goals. Without knowing why they are investing, motivation fades easily. Clear goals such as financial independence, retirement security, or building family wealth create direction and commitment. Some investors focus entirely on returns while ignoring their savings rate. Investment performance matters, but consistent contributions often play an even larger role. Increasing the amount invested regularly accelerates growth significantly. Another challenge is believing that investing requires perfect knowledge. Many beginners delay starting because they feel unprepared. In reality, experience grows through participation. Waiting for complete certainty often leads to years of missed opportunity. Emotional reactions during downturns continue to destroy portfolios. Fear encourages investors to sell during declines. Unfortunately, recoveries often follow shortly afterward. Those who stay invested typically recover faster and continue growing. Another hidden problem is lack of financial structure. Without automatic contributions, scheduled reviews, and clear rules, investing depends on mood. Systems remove hesitation and support consistent long-term behavior. In the end, investing success is less about predicting markets and more about controlling behavior. Those who manage their emotions, maintain discipline, and stay consistent through uncertainty gradually move ahead, while others fall behind. Another reason most people fail at investing is that they constantly change their strategy. When markets rise, they become aggressive. When markets fall, they become cautious. This constant switching destroys consistency. Successful investors create a plan and follow through different market conditions. Stability allows compounding to work without interruption. Many investors also underestimate the danger of overconfidence. After a few successful trades, they may believe they have mastered the market. This confidence often leads to larger risks and less careful decisions. Markets eventually correct that attitude. Discipline and humility protect investors from damaging mistakes. Another hidden mistake is ignoring long-term thinking. Some investors measure success only by short-term performance. If their portfolio does not grow quickly, they lose confidence. But investing is a marathon, not a sprint. Long-term patience often produces results that short-term strategies cannot match. Many people also struggle because they react emotionally to losses. Seeing a portfolio decline can feel uncomfortable and stressful. Instead of staying calm, they exit the market to avoid further pain. Unfortunately, this locks in losses and prevents recovery when markets rebound. Another factor is poor financial habits outside investing. Spending more than you earn leaves little money to invest. Even the best strategy cannot work without consistent capital. Healthy financial habits create the foundation for successful investing. Some investors believe they must constantly take action. They buy, sell, and adjust their portfolio frequently. However, too much activity often creates mistakes. Many successful investors understand that sometimes the best decision is simply to hold and wait. Another reason people fail is ignoring diversification. Concentrating money in a single asset may look promising at first, but unexpected events can quickly damage that investment. Diversification spreads risk and increases the chance of stable long-term growth. Many investors also underestimate the role of discipline during boring periods. Markets sometimes move slowly for months or years. Without excitement, motivation fades. Yet these quiet periods are where consistent investors continue building positions. Another mistake is focusing too much on predicting the future. No one can perfectly forecast markets, interest rates, or economic cycles. Instead of predictions, successful investors rely on strong principles and adaptable strategies. Ultimately, the biggest difference between successful investors and unsuccessful ones is behavior. Knowledge matters, but discipline matters more. Those who control emotions, remain patient, and follow a clear plan often achieve results that others never reach. Another reason people fail at investing is distraction. New trends appear constantly, promising fast profits and revolutionary opportunities. Many investors abandon their original strategy to chase these ideas. Each switch resets progress. Staying focused on a clear long-term plan protects consistency and allows investments to mature properly. Many investors also underestimate the importance of time in the market. Waiting for the perfect moment often leads to endless hesitation. While someone waits for ideal conditions, years of compounding may be lost. Consistent participation usually produces better results than perfect timing. Another problem is misunderstanding volatility. Market fluctuations are normal and expected. Prices move up and down as part of the natural cycle. Investors who interpret every decline as failure often exit too early. Those who accept volatility as normal stay invested longer and benefit from recovery. Some investors focus only on exciting opportunities and ignore steady growth. Reliable assets that grow gradually may appear less attractive. However, these steady investments often become the strongest foundation of long-term wealth. Slow progress is still powerful progress. Another mistake is believing that wealth requires complex strategies. Many people search endlessly for advanced techniques and hidden formulas. In reality, simple principles like diversification, patience, and regular investing often outperform complicated systems. Many people also fail because they stop learning. Financial knowledge evolves as markets and technologies change. Investors who continue learning adapt more easily to new conditions. Curiosity and education strengthen confidence and decision-making. Another important factor is emotional resilience. Investing includes setbacks and temporary losses. Those who cannot tolerate these moments often abandon their strategy too early. Resilience allows investors to stay committed even during difficult periods. In the end, most people fail at investing not because opportunities are rare, but because discipline is rare. The market rewards patience, consistency, and emotional control. Those who master these qualities gradually build wealth while others repeatedly start over.